What is a tax shelter? That's today's episode. Let's dive into it. Hey everyone, welcome to the Investing in Real Estate show. I'm Clayton Morris, longtime real estate investor. This is the show where we help you build passive income. We help you create tax shelters. After all, that's what real estate investing is all about. We use buy and hold real estate as the methodology, the vehicle that we use to get there. But remember, I don't care about real estate, four walls and a roof. Care about the tax shelter, caring about the passive income and the cash flow from your properties. That's the goal. That's what we teach you here today. So get a lot of questions around the idea of a tax shelter. And I think a lot of people don't know or not very aware of the fact that real estate, yes, the cash flow is great, right? Cash flow is great from a passive income perspective for your rental properties. But what you're really buying, the reason that real estate investors pay $0 in taxes is they're buying a tax shelter. And when you buy a tax shelter, you're mitigating all sorts of other income. So I want you to think about a tax shelter like a bomb shelter. What is a tax shelter? Think of it like a bomb shelter. It's a way for you to shield your wealth, your income from taxes. That's it. That's the bottom line. So picture that 1950s bomb shelter, okay? And you've got your cash flow from your rental properties and from your W-2 day job, and you've got cash sitting there. You've got a portfolio of rental properties that are shielding you. Now, how are they shielding you? We're going to get into some specifics here, but does that make sense? That it's acting as a shield against you having to pay taxes. Now, the reason that real estate investors pay nothing in taxes is because of a few little tricks and tips that I'm about to give you as we go through this. So, as an owner of an investment property, you're taking in taxable income, right? So you own a $70,000, $80,000 property. I just bought an $80,000 property and it's cash flowing a certain amount of money. That money is taxable from my tenant, right? That's taxable income. That my tenant is paying me, and therefore I have to pay Uncle Sam. However, the government and the tax code enable you to take all sorts of benefits and depreciation and deductions that basically allow you to keep almost all of that cash flow if you do it right, if you structure your deals properly. So there's a couple of ways that the government will do this and give you money back. We'll get to those in a moment. But what you want to focus on is your net operating income, your NOI, right? That's your net operating income. And that's the money that you'll pay taxes on. Okay, so let's just throw out some hypothetical numbers, right? Let's say I bought a $80,000 house. My cash flow is $1,000 a month. Now, I minus out my expenses. Maybe I've got mortgage interest as well. I'm minusing out those expenses, repairs, depreciation, mortgage interest. What I have left over, maybe it's $100. That's what I'd be taxed on. That's my net operating income that I'd be taxed on. So smart real estate investors want to be able to mitigate that net operating income with other expenses and other deductions so that it's zero. And in some cases, it could actually be negative. So you could carry that over to other income, like your W-2 income. And we'll get into that in a moment, if that makes sense. But just so you understand NOI, it's the money left over after you've accounted for all of your deductions and all of the things that you can take out of it. And then you're going to pay taxes on that NOI. Okay, so there are deductions that we as investment real estate investors, we understand, and the beauty of the tax code is written for real estate investors. It's written for entrepreneurs. It's written for the wealthy. And if you want to be on that, if you want to be against that, if you're saying, oh, I wish the tax code were written for the poor and the middle class, you can wish it all you want, or you can choose to play on the field where the tax code is written. And it's written for entrepreneurs and business owners. That's the bottom line. And there's so many great tax benefits in the tax code for you as a business owner. So I want to help you with this financial intelligence. Okay, let's go through some of these deductions that you can take away from your net operating income that the government fully allows you to do. Now, let's say I bought that $80,000 property and I got a mortgage on it, right? Maybe I put down $15,000 to $20,000 and I have a mortgage on the rest of it. That mortgage interest that I'm paying every month on that investment property, guess what? Yes, it's a deduction. Now, that would come off of my net operating income, what I'd have to report to Uncle Sam and pay taxes on. So mortgage interest, that's good debt, right? It's a difference between that and credit card debt. Mortgage interest, good debt. So that's a very powerful tool in your quiver as you're looking to reduce your net operating income. Next up, depreciation. I mean, come on. Is there anything better than depreciation? And it's your presumed decline of the property, meaning that the government presumes that you're buying this large earth-moving digger if you run a big landscaping company, and you can depreciate that as an asset in your company. The same is true with real estate. You can depreciate that asset over time. The roof. And now the government has enabled you to deduct and depreciate items in the house, like the roof and other parts of your HVAC system and other things inside the house are now able to be broken down and separately depreciated if you do what's called a cost segregation. So now that might not apply to you if you're just doing one-off small little tiny single-family homes, but if you've got a portfolio of 15 to 20 properties, cost segregation, that's the way to go. So depreciating these assets. The beautiful part, though, of depreciation is that it's a non-cash deduction. So what does that mean? Well, in other words, you don't need to write a check in order to get this deduction. It doesn't affect your cash flow. So it comes off of your bottom line. You don't need to mail in money like a mortgage payment in order to get this deduction. The government is basically looking at your assets saying, we're going to allow you to depreciate it over this amount of time. Bottom line, and it's that simple. What's great about that is that it's a shield, okay? And this depreciation, the mortgage interest, it shields you from the money that you're having to pay out to the government. So if you purchase a $200,000, $300,000 unit property and you've got a mortgage on that mortgage interest plus depreciating, the HVAC systems, the roof, and all of the different units that you're buying, now, what's left over is the cash flow from your tenant. The goal is to keep acquiring real estate. Now, here's the real trick, and this is what rich people understand. This is what real estate investors understand, is that you can exceed the amount needed in order to keep that cash flow going. So what I'm saying is, if you have one property that's creating a tax shelter for you, you can then take and buy additional properties that will then help you exceed your net operating income expenses. So let me break it down this way. It can get a little complicated, okay? But let's say you've got a W-2 job. So every year you're making $200,000, you get cash flow from your day job. We know that paycheck employees, they're taxed the worst by the government. You get no incentives. In fact, under this tax law, you're hit the hardest. Well, what if you purchased real estate that enabled you to mitigate that income? Okay? That's the beauty of the tax shelter. So now you're making $200,000 a year from your day job. You're getting taxed to the hilt, right? The cash flow you have left over, that's what you've got left over. But what if you could reduce your taxable burden from the day job with real estate? That's how it works. So again, let's say I purchase a couple of properties and after deducting the depreciation, the mortgage interest, repairs, expenses, other items, and I'm put into sort of a negative space now, negative money, meaning that I don't have to pay any taxes on the rent that I'm getting from these tenants, but I've got 15% left over now. Guess what? Now I can offset the income from my day job with real estate, with the tax shelter that I've created. So there are a lot of entrepreneurs. I have multiple businesses. Now I have a certain business that I make a certain amount of money on, but now that cash flow is offset by my real estate holdings. And it's a totally different company. I purchase my properties in LLCs, right? So when I purchase that $80,000 property or $90,000 property, those depreciation, those deductions can carry over to the income that I'd be making either from a day job, a W-2 job, or another business, right? And that's the beauty of this passive income strategy under the tax shelter. So you'll hear, it's hard for some people as a new investor to wrap their head around this idea that, I'm getting started with real estate investing. I can't wait to buy my first rental property because I want that $800 a month in cash flow. That's great. But what you're really purchasing, the power of what you're purchasing is a tax shelter, Just drill that into your brain. When you're at dinner parties with friends and family and they're asking you that you're getting involved in real estate and they're like, well, I hear that's a risky thing. First of all, it's not if you buy smart, right? Like I do. And when you talk to them about it, let them understand that, yes, I make a lot of money in my day job, but now I'm paying way less in taxes because I'm a real estate investor. And that really starts to hit people upside the head. They start to scratch their heads and go, wait a second. Oh, how does that work? Well, exactly the way we just explained it. Share this video with them. Share this podcast with friends and family that could benefit from learning what this tax shelter really means. And I just scratched the surface. You can go much, much deeper in the deductions and the way in which you can mitigate your overall income using real estate as a tax shelter. I mean, think about it. I've had investor friends who love repairs on properties, and I do too. Why? Because it adds to their tax shelter. They get excited when they have to replace a water heater, when they have to do extra repairs. Those things are depreciable, and they're able to then further increase their tax shelter. I have investor friends who love when their property gets destroyed in a storm. Why? Because they can take a FEMA claim on the property, and now it's a permanent tax shelter for the rest of their life. They'll never pay taxes on that property. It becomes its own tax shelter within a tax shelter. When you start to understand and unravel the beauty of this, it really can become a powerful tool for you to increase your overall net worth and your financial intelligence. So thank you so much for subscribing. If you're not already a subscriber, please do. We love having you here on the show. We love your feedback, and we love you joining us on our live shows as well, which we do on our YouTube channel every Wednesday at 11 a.m. Eastern Time. So just come over to the Morris Invest YouTube channel and join us there. Until next time, everyone, go out there, take action. Become a real estate investor. It's the #1 way to build wealth. We'll see you next time.